Good evening, everyone.
Hello, Picky Man. Hello. हेलो
यस
पिंकी
अंकित,
मैडम म्यूट पे है। उनका नेटवर्क थोड़ा इशू प्रॉब्लम हो रहा था श्वेता मैडम का, तो आप स्टार्ट करें। पिंकी
ठीक है,
मैडम
मैं करती हूँ
प्लीज
मैं
स्टार्ट।
करती हूँ मैं करती हूँ आ गई श्वेता, आ गई।
I'm so sorry. I don't know, but it's got disconnected in between. Yeah. So, good evening, everyone. Myself, Shweta Jain, Regional Council Member, and it's my immense pleasure to welcome you all on yet another interesting session under the WOW series, which is Women on Wednesday. I recognize the presence of our Chairman, WIRC, CA Ankit Rati, Treasurer, CA Pinky Kedia, Speaker of today's session, CA Shazia Khatri, and Coordinator for today's session, CA Monica and CA Vartika. Before moving formally ahead, I request everyone to please put your hand on your heart for the ICI motto.
य एष सुप्तेषु जाग्रति य एष सुप्तेषु जाग्रति कामं 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 कामपुरुषो पुरुषो निर्विमाणः निर्विमाणः तदेव शुक्रं तद्ब्रह्मा तद्ब्रह्मा तदेवामृतमुच्यते तस्मिन् लोकः शतः सर्वे तदूनात्यपि कश्चन एतद्वैता 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 एतद्वैता।
Thank you. Over the years, the economic landscape of India has gone through a significant transformation with the, I think, spread of globalization and digital economy. And with the increase in cross-border transaction between India and various other countries, the importance of international taxation and transfer pricing is growing rapidly. So it is really important to know for as a professional for all of us, so how it is impacting and what are the opportunities available, of course, in international taxation also. And today we have come up with the subject, which is, I can say, critical tax issue across the globe. But rather, I can say is another good opportunity, and there is an immense of career opportunity for the professionals as well in this particular domain. And for that, we have Shazia Khatri with us. But before handing over to Shazia, I would request to our treasurer, CA Pinky Kedia, to please share your words with all the participants. Over to you.
Thank you, Shweta. And I want to thank Sajia to accept our invite for today's discussion on transfer pricing. As rightly said by the Shweta, transfer pricing have many challenges and issues also. But many of times we don't know the scope and what is meant by transfer pricing and what the areas or what are the transaction covered in transfer pricing. why we should do calculation for transfer pricing, and in bank audit also we are checking transfer pricing issues, but why we are checking this, or why there is a need to do that, that we don't know sometimes. So it's a very good topic taken by Shazia. So we should know about the basic things about the topic, which is very relevant topic for nowadays in our current scenario. Because now after COVID, or you can say, after COVID, there is many cross-border transactions are happening. And so transfer pricing applicable to many of the our client, or many organization also. So thank you, Sadia. So we also can learn from you about the this topic very well. And thank you, Sweta, to organize this very much needed topic for the WOW series. And one more thing, I request all the participants, please register yourself for regional conference, which is going to happen on 23rd and 24th August at Geo Convention. And it will be a very, very large event. And very, you will get many type of network and knowledge. And there will be very large experts, very renowned experts are coming for each and every subjects and topics. Details are available on our WRC website with all the topics and speakers detail. So you can go through our WRC website and register yourself positively, because it will be a good experience for you all. We are working day and night for the event in WRC. So please join the program event. We will meet there. And till there, thank you again. Over to Sweta, please.
Thank you so much, Pinky. Yes, of course, it's a grand event. It is going to, we are organize it at WRC level. So let's hear directly from our chairman, C. Ankit Rathi. Over to you, chairman.
Thank you, Shweta madam. Very good evening. It's indeed pleasure to be here with you all in this virtual room of our Western India Regional Council. At the outset, let me first recognize both the wonderful leaders of our regional council. First, of course, Treasurer Western India Regional Council Pinky Kedia, and then past Secretary of our Western India Regional Council Shweta Jain madam. My sincere thanks to both of them. They both are doing really great, wonderful work for the fraternity. Madam, kudos to you. Now let me also thanks to our today faculty, today speaker, Shazia Khatri. Madam, thank you so much. Despite of your so much busy schedule, you being agreed to share your valuable knowledge with our participants. We are really grateful to you. Let me also thanks to our both the coordinator, Monica Gupta and Vartika. Madam, thank you so much for your time for the fraternity. Friends, let me also request you about the regional conference, 38th regional conference. First time we are hosting in Geo Convention Center with the I can say we are anticipate participants somewhere around more than 3,500 with more than 75 exhibition stall. We are already invited more than 100 speakers and panelists in this two-day regional conference. Let me tell you some of the names like Jaya Kishori ji, Piyush ji Goyal, Suresh Prabhu, Chairman of State Bank of India, Whole-time Director of Security Exchange Board of India, and many other dignitaries. So my sincere request to each one of you, please do register for this type of regional conference. This is the annual event in which we trying to participate, in which we request everyone, please take the participants. We try to deliver what we can say the best out of the best in this two-day regional conference. With this, I wish you all happy learning. The today topic is again, I can say very interesting at the rightly point out by our regional council member Shweta madam, that cross-border transactions and the transaction related to international border are increasing day by day. Happy learning with this. My message to each one of you. Thank you so much.
Thank you so much, chairman. I can tell you, friends, of course, very energetic chairman, and day night every day ये है कि आज कुछ नया करना है. This is something going at WIRC, and this time we are hosting our regional conference at Geo World Convention Center. Of course, it's a first time, and क्या level पे वो conference होगा, we cannot even imagine. So again, from my side also, I'm requesting everybody to please register for the conference. So moving ahead, I request CA Monica Gupta to please introduce formally our today's speaker. Over to you, Monica.
Thank you, ma'am. CA Shazia Khatri has 13 years of post-qualification experience and specializes in transfer pricing. Shazia has worked on a wide variety of assignments and has assisted several multinationals on planning their transfer pricing strategies, in preparing documentation, and represented them in the course of their transfer pricing audits, appellate proceedings, and APA discussions. Shazia has serviced clients across various industries, including IT, ITES, financial services, shipping, logistics, etc. Over to you, Shazia ma'am.
Good evening, everyone. And it's a privilege, and I thank WIRC for giving me this opportunity to speak on this topic, which is not only India specific, but also a topic which is gaining importance across the globe. Thank you, Shweta ji, Pinky ji, and Ankit sir for keeping a faith in me to cover this topic, so as to give the participants an overview of what opportunities we have in this career, which is least explored by professional currently in the present scenario. So today, the agenda is to give a broad overview of the framework of the transfer pricing regulations in India, and what are the opportunities for us as a professional, and also as a professional working in the corporates, what are the things that we should be keeping in mind. Because even if you are working in a corporate, not a practicing professional, this topic is of equally importance to you. With this, maybe I will just share my screen so as to put the slide on the screen. Any questions, you can put it in the chat box or a Q&A box, and I'll be happy to take either during the session or at the end as the time prevail. Is my screen visible? Okay, great. So as you may be aware, transfer pricing in a literal term means setting price for intercompany transactions or transactions between related party. Now, the entire focus of transfer pricing regulations, and it is regulations which are not only implemented by India, but there are more than 100 countries who have implemented these regulations in their respective jurisdiction. The entire premise of transfer pricing regulation is that the transaction between the related parties are priced in an arm's length scenario. It means that the transaction pricing should be such that they should reflect as if two unrelated parties are transacting. Now, why is it important? Because corporates or multinational companies could use this as a tool to evade the taxes. Let's say they would probably shift the profit or the income from a high tax jurisdiction to a low tax jurisdiction. And therefore, to prevent any kind of a tax evasion, these provisions are introduced in the regulation. These are generally anti-evasion provisions. Now, transfer pricing is important not only from a corporate multinational, but also from a government standpoint of view, because as we said that your tax evasion, most of the tax evasion, probably transfer pricing is a tool that multinational may use it. And India is no exception, where we introduced this transfer pricing regulation sometime in 2001. And since then, the transfer pricing provisions have evolved. And in fact, we have also seen the maximum litigation in transfer pricing. So in fact, India is the highest litigator when it comes to the litigation. Transfer pricing is a topic which is of the highest litigation in India today. Every aspect of transfer pricing is being litigated, right from what is the definition of associated enterprises, are the two entities associated enterprises, is a transaction an international transaction, like guarantee, is a guarantee a service transaction or not, that those kind of litigation have happened. Be it your selection of the method, the application of filter, even as simple thing as what is the computation, how do you compute a profit margin under the transfer pricing principle, that has been a subject matter of litigation in India. And this litigation is not only something which has traveled to the tribunal, In fact, transfer pricing has traveled to even from tribunal to High Court and to Supreme Court. It is said that transfer pricing is mostly a factual exercise. There shouldn't be, because it's all depend on the facts. What is the operation of the company? What is the transaction involved? So there's no question of interpretation. However, it is seen that the litigation in transfer pricing have traveled to Supreme Court. And in fact, I would just like to touch upon one recent ruling from Supreme Court in case of SAP Labs, where the Supreme Court has said even an issue of selection of comparable is a matter of law and not of fact. And therefore they have directed, so entire 90 appeals which were disposed of by High Court to say that transfer pricing does not involve any question of law, it is only a question of fact, have been pushed back to the High Court. So that's the intensity of litigation that this subject has. And today we will be just covering what are the key aspects of this topic, what are the basic aspects of this topic, and how as a professional we can work in this area. To begin with, just give me a minute. So as we said, India introduced transfer pricing provisions in 2001, White Finance Act 2001. And today it's more than 20 years since we have these provisions in India. Now, these provisions are based on a basic concept which says that any income or an expense arising from an international transaction with associated enterprise or in relation to specified domestic transaction shall be computed having regard to the arm's length price. Now, couple of key things. One, it refers to any income or an expense. So the thing is that this transfer pricing provision, which are there from section 92 to 92F, they don't create a separate charging provision, but are merely a machinery provision to determine how the income should be taxable. What would be the income which will be taxable? So unless an income is taxable under the Act, transfer pricing provisions cannot apply. So an income is defined under section 224, and it's a very wide definition. It covers a lot of things, but not all received are considered as a taxable income. For example, the classic case of Vodafone we would have heard of, wherein the High Court had said that the capital received on account of issuance of a share by an Indian entity to its non-resident related party may not be subject to a transfer pricing because there is no event of an income which is arising in India. Now, of course, this ruling was pre 5627B was amended. So, so that lays down that at first instant, there has to be a taxable income or an allowable expense under the Act for these provisions to get triggered. Now, how these provisions are structured, as we can see, it says that any income arising from international transaction. So there's a section which deals with what is an international transaction with associated enterprise. So there's a section 92A which deals with what is the definition of associated enterprise. We also have something which is called as a specified domestic transaction, which implies that there are certain domestic transactions which may be subject to transfer pricing. And how do you compute an ALP? What are the ways of determining whether your transaction is at arm's length price or not? So we have the methods for computing an arm's length price under section 92C. Of course, now if a multinational companies are entering into any kind of a transaction, how would government know? Or how would CBDT or tax offices know that you have entered into a transaction? So there are certain reporting obligations, there are certain obligations to maintain the documentation. So that's the second set of provisions which we have, which is in terms of section 92D and 92E, which deals with your accountant's report, which is a report which needs to be filed in form number 3CEB, giving specific of these kind of transactions. We also have provisions in terms of maintaining the documentation, because once you have entered into a transaction, we need to demonstrate how this transaction is at arm's length. And for that, we have certain prescribed documentation to be maintained, which are in terms of transfer pricing study report. Considering the global development, we have also adopted the concept of maintaining a master file and filing of a country by country report. We'll be discussing each of these concepts as we proceed further into the session. Of course, what happens when you don't comply with the provisions? There are stringent penalties. Yes, there are penal provisions under the Act for non-compliance with the transfer pricing provision, and they are very stringent. They are linked to the value of a transaction. Higher the transaction, higher the penalty. So there are sections which deals with the penalty. And second, of when there is any kind of a scrutiny and you have any kind of a transfer pricing or international transaction, there are specific provisions that deal with how the assessment process needs to be undertaken. There are specialized officers who deal only from a transfer pricing perspective. So there's a different wing clearly looking at transfer pricing assessments and how they are built into the entire assessment procedure. In any case, there is any kind of a litigation in terms of tax authorities not agreeing to your pricing or making any kind of an adjustment under TP. So there are various dispute resolution panel. So today we'll be covering a gist of all these kind of a provision at a very high level. These topic are detail in case one were to speak of any topic, let's say an associated enterprise or an international transaction, it would take almost an hour. So today we'll be just touching upon the basic principles, and any questions I'll be happy to take. So maybe we can start, let's start with the definition of associated enterprise. Now the definition of associated enterprise is given in section 92A. Section 92A has basically it's divided into two sub clauses, two subsection. Section 1 is more of a conceptual in nature, while section 2 gives more of a specifics to the concepts which are enshrined in section 92A1. So what does it say? It says that if any enterprise participates directly or indirectly in management, capital, or control of the other enterprise. So let's say you have company A who is holding 90% in company B. So there's a participation in capital by company A in company B, and therefore they two will become an associated enterprise. Let's say it's not a direct participation, but there are certain intermediaries in between, then also it will be considered as an associated enterprise. It also says that even if there is any common participation in two enterprises, then also there will be an AE relationship which will be getting triggered. Now, interestingly, 92A1, which is a concept definition, it doesn't give any kind of a threshold. So if this subsection 1 was to be looked at in a standalone basis, even a 1% capital by any company, 1% participation in a capital by company A to company B would constitute an associated enterprise. Now, it's 1% is not a material threshold or material enough to influence the transaction, and therefore, in order to supplement the concept, 92A2 has been introduced, which gives 13 conditions. So there are 13 conditions which are prescribed under section 92A2, wherein the two enterprise would be deemed to be an associated enterprise. Now, what these 13 conditions are, these are nothing but they again relate back to either they are participation in capital or participation in management or any kind of a control that one enterprise has on the other enterprise. So some of those critical conditions are, there's a threshold of 26% which has been prescribed for any kind of a capital participation in the voting power participation, which is your either equity shares or a preference share. Again, capital could be in a form of a debt. So there is also a condition which says that if an enterprise has given a loan which is in excess of 51% of the total asset of the other enterprise, then they would be considered as an associated enterprise. Similarly, there's a condition around the guarantee. We have a conditions around participation in the management in terms of board of directors or executing committee. And there are also conditions in terms of exercising a control, either it's a commercial relationship, control through a commercial relationship, example, dependency on the technology know-how, complete dependency on a technology know-how of another company, or any kind of a personal relationship. Maybe, you know, an individual or its relatives are managing the companies jointly or so. So those are the relationship which are mentioned in section 92A2. Now, one interesting thing under this definition is it speak about at any time during the previous year. So if I may just read, it says, for the purpose of subsection 1, two enterprises shall be deemed to be an associated enterprise at any time, just give, if at any time during the previous year. Now, this is an interesting thing. It says at any time during the previous year. So let's say if there's a transaction which has happened between company A and company B on 1st July 24. Okay, there's some purchase of goods which has happened between company and company B. These two were independent entities at that point of time. However, subsequently, let's say after a month, on 1st August 24, company A took over company B and they acquired company B. Now, clearly the A relationship got triggered on 1st August because before that they were completely independent. However, because of this wording, even the transaction which had took place before they were associated enterprise would need to pass the test of transfer pricing and needs to be reported and tested whether it is at arm's length or not. Now, other interesting thing which was under litigation and which came up before the court was, if let's say two enterprises, they satisfy any one of these conditions. However, there is neither any participation in management or capital or control, would they still be regarded as an associated enterprise? Now, this particular controversy was extensively dealt in by various tribunal, and one important judgment in this regard is Orchid Pharma, which is a Chennai tribunal decision. Maybe I will just spend a couple of minutes in giving what are the facts in this case and how the tribunal dealt with this controversy. So in this case, the assessee is a pharmaceutical company. They had entered into a distribution arrangement with North Star, where the assessee used to manufacture the API products. North Star would be assisting the assessee in distributing these products in the various market. And there was one more party, Activas, who was helping in the research and development. Now, this was one of the commercial agreement that the assessee has entered into with these two entities. These two entities are completely unrelated to the assessee. These two entities were completely unrelated to the assessee. There was no participation in management or capital by these two in the assessee. Now the question came up, and so the goods which are manufactured by Orchid or the assessee, they were sold, they were given to the island entity, and island entity distributed it further. The entire negotiation with the end customer was done by this island entity, which is the distribution partner. Now we have section 92A2I in the associated enterprise definition, which reads as, the goods or article manufactured or processed by one enterprise are sold to the other enterprise or to the person specified by the other enterprise, and the prices and the other conditions relating thereto are influenced by such other enterprise. Now, the transfer pricing officer or the tax authorities, they took this clause and they said that there is an A relationship which is getting triggered between the assessee and its distribution partner, because the goods which are sold to the to the end customers are influenced solely by the distribution partner, and the assessee is only getting its share on its profit share as per the term of the agreement. Now here, important fact to note is that the income of the assessee out of this arrangement is only 5% of the sales. Or if one were to look at, it was only 6% of the export. Now the question came up, if they don't have any kind of a management or a capital participation, merely because there's this kind of a commercial arrangement by the assessee with its customer, can they be considered as an associated enterprise? Now, literal reading of this clause, section 92A to I, it says that yes, because they satisfy this condition, or they meet, or there's some kind of an influence which has happened. But are they really? So this came up before the tribunal, and tribunal said that what needs to be seen is section 92A1, which is a conceptual definition, which says that there has to be some participation that has to be read along with section 92A2. So in short, both the subsection needs to be read together. Now, in this case, clearly these two parties, one was the distribution partner and other was the entity doing a research and development, they have no linkage whatsoever with the assessee in terms of management and capital. Now, what about the control? So we come to the third aspect. Is the threshold of 5% significant enough to exercise any kind of a control? The tribunal said that in our view, the answer is no. Because 5% is an immaterial threshold, and it's too low a threshold. Had there been something, had this percentage been something higher, then probably one could have, come to a conclusion that there is some kind of a control which is exercised by North Star on assessee or vice versa. But here the percentage is very low. And therefore, though technically there's no threshold which is prescribed, because as just we read the provision, there's no threshold which is prescribed, unlike in the other clauses that we saw of section 92A2, which had a percentage of 26% voting power or 51% of the total asset. Even in case of purchase of raw material, there's a threshold of 90%. Unlike all those other clauses, there is no threshold which is given under this clause, and therefore probably it's a miss by the government or it's intentional, we don't know. But what needs to be seen is we need to take a practical judgment over here. Here there's clearly no such kind of a control which could be seen, and therefore these two are not an associated enterprise. Maybe let's understand the definition of associated enterprise further with the help of a case study. So let's take scenario 1. Here we have a HCO holding company in UK, which has a 100% subsidiary in Singapore. Singapore has a entity in India where they are holding around 51% of the equity share capital. Holdco in UK also has an related entity in Germany where it is having a 50% stake, and Germany further has a subsidiary in Japan, which is ESCO 2 in our example. Now there is some kind of a transaction, sale of services, which is happening between India and Japan entity. Now whether India and Japan would be considered as an associated enterprise over here? Yes, the answer is yes, because they will satisfy the condition of section 92A to B, which says that there's a common shareholding holding more than 26% voting power in both of these enterprises, which is India and Japan. So if we see HCO, which is in UK, is holding indirectly 50% stake in India and 50% stake in Japan. So they meet the threshold of 26%, which is prescribed under section 92A, and therefore any transaction between these two entities would be considered as an associated enterprise subject to transfer pricing regulation in India. So it's important to analyze the shareholding structure and see where the transactions would fit within the A definition. Even let's say there was not a company but an individual who was exercising some kind of a control either in a capital or a management, whether then also those two enterprises would be considered as an AE under section 92A? The answer is yes. For example, let's say Mr. A has a 99% or almost 100% stake in company which is XYZ Limited, which is resident in India. And he is also a CEO or a managing director in PQR Limited, which is outside India. In case there is any transaction between this Indian entity and this overseas entity, in our case PQR Limited, that would also be subject to transfer pricing provision, because by definition they will be considered as an associated enterprises. Any questions so far? Will be happy to take. Before we move on to this next section, I was just checking if we have any question on this definition. If no, we will move on to the next concept, which is the definition of international transaction. Now, again, definition of international transaction is divided into two subsections. Subsection 1, which deals with, or which says any transaction between two associated enterprise, either or both of whom are non-resident. So the important criteria over here is either one enterprise has to be a non-resident, or both of the enterprises, one enterprise has to be a non-resident, or both enterprise has to be a non-resident. And it covers a wide variety of transaction, everything. It could be your purchase of tangible, intangible services, even capital financing, any kind of a business restructuring. So the definition of international transaction per se is very wide. Whether the transaction between two residents would come within the purview of international transaction? No, it will not come. The transaction between two residents will not come within the purview of section 92B. However, we have a specific section 92B, 92BA, which deals with specified domestic transaction, which we will cover upon later in this session. Now, there's also a deemed international. Okay, before we go into the deemed international transaction, maybe just we will just understand regarding this concept. Let's say there's a head office which is outside India. They have a branch in India. Now, any transaction between this head office and the branch, whether it will be considered as an international transaction? Yes, because head office being outside India, it's a non-resident. Its branch, though it is in India, it is classified as a non-resident. So it's a transaction between two non-resident having bearing in India. So it will be subject to transfer pricing provisions. Now, if one were to look at it as a flip, let's say the head office is in India and it has a branch outside India, whether this will come within the purview of transfer pricing? The answer is no, because head office in India is classified as a resident. The branch of an Indian headquartered company is also classified as a resident from an Income Tax Act perspective. And therefore, this will be considered as a transaction between two residents, not subject to transfer pricing provision. Now here, this is a controversy which is being litigated. Again, per definition of international transaction, it will not be subject to. However, if one were to look at in principle, I could, even if I'm a Indian headquartered company, whether it's possible for me to shift any kind of a profit outside India through a branch, the answer is yes. And principally, whether TP should apply or not to this, logically, if one were to think at it, one would say yes, it should have been applicable. And this particular controversy today is pending before the special bench. There's a special bench which has been formed in Ahmedabad Tribunal. The matter was heard earlier but released because of some reason, and we again have the hearing scheduled in this month. So it's an interesting controversy to wait and watch. We also have a concept of deemed international transaction. Now, this concept of deemed international transactions was introduced in the provision to circumvent any kind of an interpose of an unrelated party. So it was to prevent any taxpayers to impose an unrelated party in between, just to prima facie avoid the provisions, and therefore these provisions were introduced. What it says that any transaction between an enterprise will be deemed to be an international transaction if there exists a prior arrangement between the associated enterprise and the unrelated party. So any transaction between the assessee and an unrelated party would be deemed to be an international transaction if there exists a prior agreement in relation to such transaction between the associated enterprise and the unrelated party, or the terms in substance. So the terms of the transaction are in substance determined by an associated enterprise which is outside India. Then this transaction between the Indian entity and that unrelated party, whether it is a resident or a non-resident, would be deemed to be an international transaction. Now, what could be an example? Let's say India entity, they are procuring a laptop from an unrelated company A. The procurement of this laptop has been agreed by an associated enterprise. So there's an associated enterprise who is sitting in UK, who is agreeing or who is negotiating the entire terms of how this procurement will happen, what will be the volume which will be purchased, what will the price at which it will be purchased, what will be the bulk discounts which will be given. So while the transaction may appear as if the Indian entity is purchasing the laptop from company A, which is closely unrelated, but there is some kind of a role which is being played by the associated enterprise. And therefore, this transaction would come within the purview of deemed international transaction. I think we just pause here. We have a question in the chat box. Maybe do we want to take it now or at the end? So there's a one question which says that for associated enterprise, in case of a bank, like one enterprise appoints the board of the directors of the associated enterprise, how do we check it? So here we should be asking the factual questions to the client in terms of who is who is appointing the board of director, and if there's a common person, then yes, in my view, they may be considered as an associated enterprise, but it will all depend on the facts of this case. Do we have any other question? Okay, I think that was it. We move on further. So now there are certain, as we discussed, there are certain domestic transactions which are also within the purview of transfer pricing. Now, why was there a need to bring these domestic transaction within the purview of transfer pricing? It was because there was certain kind of an arbitrage, because as we know, any domestic transaction per se are revenue neutral. Only the tax arbitrage could happen if there is any kind of a tax holiday which is being enjoyed by the taxpayer, or there are loss-making entities in a group, or there is some kind of a concessional tax rate. And therefore, there was a suggestion which was given by Supreme Court in case of GlaxoSmithKline. And from that, the provisions of taking a clue from that recommendation, CBDT brought in certain domestic transactions within the purview of formal TP regulation. Now, what kind of transactions are covered? These are basically targeted towards those enterprises who are either enjoying any kind of a tax holiday or any kind of a concessional tax rate. So let's see what are they. It refers to section 92BA. 2 refers to any transaction referred in section 80A, or any transfer of goods or services referred to in subsection 8 of section 80IA. Now, what these sections deal with are basically inter-unit transfer. So let's say there's a company, there's a taxpayer A Limited. It has 2 units. One is a tax holiday unit and other is a normal non-tax holiday unit. So tax holiday we generally refer to as eligible unit in terms of section 80IA and other provision. So if there is any transaction between eligible unit and a non-eligible unit, transfer of any goods or services, then those transactions needs to be reported as a part of SDT, and formal TP provision needs to be complied with. Or these transactions, in other words, these transactions needs to be tested from an arm's length perspective. Now, government has given, or the act has given a threshold of 20 crore for these transaction threshold of 20 crores so as to not burden the small taxpayers to comply with the onerous requirement of maintaining the documentation, etc. The other transactions which are covered is in which is section 92BA4. It reads as any business transacted between the assessee and other person as referred to in subsection 10 of section 80IA. Now, what does subsection 10 of section 80IA says? It says that any transaction between an eligible assessee and a closely connected person. So let's take, for example, A Limited. It has a tax holiday unit. Or it's an eligible assessee. Now it has a transaction with B Limited, which is a closely connected person. Now, closely connected person is not defined under the Income Tax Act. So one needs to see from a commercial standpoint whether they will be considered as a closely connected. Either there is a subsidiary relationship or there is any kind of a management participation that needs to be seen. So if there is any transaction between A Limited and B Limited, that needs to be complied with the arm's length principle. Now, this is to prevent that A Limited should not show more than ordinary profit, because if it is showing the profits which are higher, and this is a transaction which is playing a role in determination of a profit, then this needs to be corrected, because your transaction has to be as if they were being undertaken in an arm's length scenario. The provision section 92BA also expands not only to 80IA but also to other provisions either under chapter 6A or other provision or any other provision to which subsection 8 or subsection 10 are applicable. So it could be any kind of your profit link deductions which are available under the Income Tax Act. All those assessees will have to comply with the TP provision, or will have to be tested to see if they fall within the definition of SDT or not. We know that government introduced the concessional tax rate for manufacturing entities in the form of companies and corporate society in the form of section 115BAB and section 115BAE. So any transaction between the entity who has availed this tax concessional tax rate and any other person which is a closely connected person, it also needs to be tested whether the transaction are at arm's length or not. As we discussed, the aggregate value of such transaction should exceed INR 20 crore to qualify it as a specified domestic transaction. So there's a threshold of 20 crore which have been mentioned. Now, earlier when the SDT provisions were introduced, even transactions with person which are referred to in section 48(2)(b) were part of the specified domestic transaction. And this clause was omitted by Finance Act 2017. Now, interestingly, when this clause was omitted, there was no saving clause which was there. And a question came up before the tribunal and a court: what would happen to any kind of a TP adjustments which have been made prior to the deletion of this clause under section 48(2)(b). So there's this landmark ruling in case of Taxport Overseas Private Limited. It's a Karnataka High Court ruling, wherein this pertains to assessment year 13-14, which is prior to the deletion of the clause 48(2)(b) from the purview of specified domestic transaction. And the taxpayer, they have reported these transactions as a part of their TP filing as SDT. The case got referred to the TPO. TPO made an TP adjustment. It came up before the tribunal. The tribunal held that this clause has been omitted without any saving clause. And therefore, the result of this is that it was never there in the statute. It was never introduced in the statute. And taking this position, the entire TP adjustment was deleted. Revenue appealed before the High Court, and High Court also upheld the principle which the tribunal has laid down. So today, if you have why this ruling become important? Because after the judgment, any TP adjustment on account of section 48(2)(b) which were made even prior when that provisions were still active, could be deleted by relying on this particular judgment. So there is no scope where any kind of a TP adjustment could happen in case of section 40A 2B. Moving on further, now having understood the definition of associated enterprises, international transaction, deemed international transaction, the other question comes is that how do you determine whether a transaction is at arm's length price or not? Now for that, the Act prescribes 6 methods. 5 of them are universal methods. So these 5 methods are part of even any global guidelines. So even not in India, but any across the globe, the 5 methods are consistent. The 6th method was introduced so as to give some kind of a flexibility, and we will understand what this 6th method, which is typically known as the other method, refers to. These methods are, to start with, the comparable uncontrolled price method. Now, this is a method which compares the prices. Let's say company A has procured a bottle from its associated enterprise at 10 rupee. Similar bottle they are procuring even from an unrelated party at the same price. So that procurement from that will become a cup. So what it will test is the price at which you are procuring a goods or a services. So in a cup method, the prices are benchmarked. The comparability requirements are very high under a cup method because you need to have a same product, same market. So, there is very limited scope of any kind of a adjustment when we refer to a cup. The other method is more of on a profitabilities, which is resale price method. Now, when is resale price method used and what does it test? It tests the gross margins which are earned. So as the name refers to resale price. So if let's say a company A, which is a taxpayer, they are buying certain goods from the associated enterprise and they are selling it further in the market. So there is a resale activity which is happening. So what is the profit which is earned by an enterprise from this resale activity? That will be compared with the comparable companies. How do you identify a comparable company? So there are specific databases on which a proper search needs to be conducted to identify a set of companies, and then you benchmark the margin, the gross margin that you are earning out of this reselling activity with the comparable companies to test whether your transaction is at arm's length or not. RPM is usually adopted by the distributors or the reseller who do not do any kind of a value add. So you just purchase and you sell it. If there is any kind of a value add which is happening at the taxpayer level, then resale price may not be appropriate, because then you cannot test the gross margin because there are certain additional expenses that you are incurring which are below the gross margin calculation, wherein your value additions is being reflected. So RPM is generally used for distributors or resellers who do not add any kind of value addition to the goods that are being purchased or sold. Then we have cost plus method. Cost plus method is generally adopted by manufacturing entities. So basically, what is the cost of manufacturing a product and the profit element that gets added? And then let's say if there's a manufacturer, so it is incurring a cost of manufacturing a particular product. Let's say they would be adding their margin of 10% and selling it further to their associated enterprise. So the what will be tested as a part of this CPM is the margin that will be added by a manufacturer for the goods that they are manufacturing. Again, the way the regulations are worded or the way the rules are worded for a CPM, it requires a benchmarking at a gross margin level. And sometimes the gross margin details in case of comparable companies are not available. And in practicality, I have seen limited practical application of CPM as a method because of the difficulties in computing the gross margin from a publicly available data. We have other method, which is profit split method, PSM. Now it is one of the complex method. It is applied also in case of a complex transaction. So let's say company A and company B, they have come together to jointly develop an IP or an intellectual property. Now, there are the efforts which are invested by both company A and company B. Both are critical to a transaction. IP is one product which will be a resultant of the efforts of these two companies. Any profit which will be generated will be split between the contributors to this development of an IP. And then what gets tested is how this profit split has happened, whether it would reflect an arm's length scenario or not, whether it would reflect the contribution that each of the party has made or not. That is what gets tested in a profit split method. Then we have transactional net margin method. Now, this is most commonly used method, and it could be applied to a lot of transaction, be it purchase of goods, provision of services. What get tested over here are your net margins. And unlike cost plus method, where you have a practical challenge in computing the gross margins for a comparable company, that practical difficulty gets diluted because we do have net margin details available for a company easily from the public databases. So that's the fifth method. CBDT they introduced, I think in 2013 they introduced the other method just to give a flexibility, because let's say if there is a transaction for which no comparable or actual comparable transaction is not undertaken, then can I use the quotation, let's say purchase of a shares. Now if it is a purchase of a listed company share, you have a benchmark in the form of a prices which are available on the stock exchange. But what if it is a purchase of a shares of an unlisted company? How do you price such kind of a transaction? So there's a valuation report which helps back the pricing. Now, whether that valuation report will be considered as a cup, there was some difficulty to say it was a cup because it was not an actual transaction. It was a hypothetical price which would be charged between a willing buyer and a willing seller, because that is what your valuation report says through. And therefore, to provide some kind of a flexibility to benchmark a transaction, the other method was introduced, which allows the use of a hypothetical price which would have been charged between a taxpayer, which would have been charged between two unrelated parties. So, it allows us to use the quotations or the valuation report as a part of this method. Earlier, there was only single year data which was allowable. So if you are conducting a transaction in, let's say, financial year 22-23, you could only adopt financial year 22-23 data to prove that your transaction is at arm's length, or to test that your transaction is at arm's length. Now, there was practical difficulty in adopting the current year data, because by the time you file your accountant's report, which is form number 3CB, and we will come to that, the data for the comparable companies was not available in the public domain, because it takes time for the companies to finish their audit. Let's say we have a timeline of September to finish the audit. By the time they do their ROC filings, from the ROC filings, when the database picks up the data, it's quite a substantial time gap which happens. And till the time of November, November was a time limit to file the form number 3CB at that point of time, which has been revised to 31st October now. It's very difficult to have a current year data available in public domain. And therefore, there was an ask from the government to allow the use of multiple year data, which was accepted. And there was a regulation, there was a notification which was prescribed to allow the use of multiple year data somewhere in 2015. Along with multiple year data, a range concept was also introduced. So earlier, we used to follow a arithmetical mean, that is a simple average, taking a simple average of the comparable. So let's say if you have more than one comparable instances, so you take the average of the two, and we used to say whether it is at arm's length or not. As opposed to this, globally, there's a range concept where there are interquartile range which are used. So let's say if your transaction globally, if your transaction fall within 25th to 75th percentile of the comparable range, then it is considered as arm's length. However, in India, the range concept was not available. Again, the government moving towards the global standard brought in the concept of range. However, we have our unique, because we are India, we have our unique range, which is 35th to 65th percentile. So today, so if we look at it from today, today the way the law stands it, so if you have only one comparable instance, then you take that single price. You have a plus minus 5% leeway which is available. So your price can be within plus minus 5% within this comparable price. If your comparable instances are less than 6, then again you have to do an arithmetical mean computation. If your comparable instances are more than 6, then you have a range concept which is applicable, where you compute a 35th to 65th percentile and you test your transaction. Now, there's a unique way of computing this 35th to 65th percentile, and we will understand in our next slide with the help of an example on how do you actually compute the 35th to 65th percentile per the law which has been prescribed. Again, the range concept today is available only to the 4 methods, which is CUP, RPM, CPM, and TNMM. If you are using PSM or other method, then you restore again to arithmetical mean if you have more than, even if you have more than 6 comparable instances. So let's study how a range gets computed. So I've put in a hypothetical instance where this company, it has 7 comparable instances from A to G. We are computing their net cost plus margin. So we have taken the profit and the cost, profit as a numerator, cost as a denominator, and computed their percentages. Now, what the law requires is, it requires, now we have allowed the use of multiple year data. So what the multiple year data says, current year data and preceding 2 years data. So I have in all 3-year data available. So we have year 1, year 2, year 3, which is plotted on the screen for each of these 7 instances. Now, if we look at serial number 2, if you really see, current year data is not available. As I said, the data of the company may not be updated in the database. However, the prior to year data is available, and therefore, as per the amended or as per the multiple year data provisions now under the regulation, I am permitted to use this as a comparable instances. So I can use this as a instances where I plot the 2-year data and leave the current year data as not available. You can also see NC on the screen. What does NC means? NC means it's not comparable. So what the law requires you is that your comparable instance should be comparable in your current year. So if it is comparable in your current year but not comparable in the past year, then you just don't take the data of the past year. You continue to take the data of the current year. The classic example is the serial number 5, where the company is comparable to me in the current year. However, in the past, for some reason, it is not comparable to me. Let's say they have a high related party transactions, or they have a negative net worth, not meeting the comparability criteria. So I have today, the law allows me to use the data only for the year in which it is comparable, which is the current year, while the rest 2 data, I can say it as NC. Okay, so what we do is we put down the operating profit for all the 3 years. We put down the operating cost for all the 3 years. The rules require me to compute a weighted average. Now, simple weighted average, it just says you aggregate the numerator, you aggregate the denominator, and then you compute a percentage. So we do an aggregation and we compute the weighted average for percentages for each of the 7 comparables. What does then the regulation requires me to do it? It requires me to arrange this data in an ascending order. So all these 7 instances as a second step would be arranged in ascending order from lowest to the highest. So we have arranged all these weighted averages from the lowest to the highest. Then we need to compute the 35th percentile. How does the formula for 35th percentile work? So the law doesn't want merely, you put it in the Excel formula and you come out with a number. That is not what the law requires. What law says, what are the number of observations you have? You have 7 observation over here. You have 7 comparable instances. So 7 multiplied by 35 percentile, which gives you 2.45 as a result. So you look at immediate next whole number, which is 2.45. The immediate next whole number is 3. So you look at the third position in the ascending data that you have done. So the third position in the ascended data in my is company number C, which is 9.04%. So this is my 35th percentile. How do you compute a 65th percentile? Again, 7 multiplied by 65th percentile, which gives me a outcome of 4.55. 4. So I take the result 4.55. So I take the next resultant whole number, which is 5th. So 5th position is comparable G, which has a margin of 10.57%. So my range is 9.04 to 10.5%. If as a taxpayer, I am earning a net cost plus margin of, let's say, 10%, I would say as a taxpayer, I fit within the range and therefore my transactions are at arm's length. If the taxpayer is earning, let's say, 7%, then their transaction will not be considered to be at arm's length because it is outside the range. You should have earned anything between 9% to 10.5%. But since you have only earned 7%, it is not at arm's length. So how do you compute the adjustment which needs to be made? The rule says that the adjustment will be computed from the median of the data. So then we proceed to compute the median. How do you compute the median? Again, 7 observation multiplied by the 50th percentile, which gives me an outcome of 3.5. 3.5 not being a whole number, I look at the immediate next whole number, which is 4. The company at 4th position. So you look at the company at 4th position, which is company D, earning a margin of 10%. So the TP adjustment will be calculated as a difference of 10 and 7. This is how the TP adjustment would be calculated. So that's in terms of computing. How do you determine whether your transaction is at ALP, and how do you compute the range to conclude whether your transaction is at ALP or not? Now comes the important area where, we as a professional do practice, which is issuance of an accountant's report. Now, what the law says, it says that every person who has entered into international transaction or specified domestic transaction shall obtain a report from an accountant on or before the specified date. So the specified date under the Act, today it's 31st October, being 1 month prior to the date of filing the return of income. Okay, and this reports needs to be obtained from an accountant. Now, accountant is defined under the Income Tax Act. So we need to maintain all kind of an independence like an auditor if we are issuing an accountant's report. It starts with every person. So either be it resident or non-resident, every person has to obtain an accountant's report. Again, there's no threshold. If you look at the provision section 92E and rule 10E, which supplements 92E, there is no threshold which is given. So even if you have a 1 rupee transaction, then also there's a requirement on you as a taxpayer to file an accountant's report in form number 3CEB. So key features of form number 3CEB, we just discussed. The due date is 31st October. Even if you have a 1 rupee transaction, you have to file form number 3CB. What about SDT? If I have a 5 crore transaction, do I need to file a form 3CB? No, because to qualify an SDT, the threshold is 20 crore. So if the transaction is 20 crore and up, then only they need to file the form number 3CB as and disclose the specified domestic transaction. Every taxpayer, be it resident, non-resident, foreign company, branches, they will be required to file the form number 3CB. How do you go about, how does this form look like? Maybe I will just, this is how a form number 3CEB looks like. So you have a report from the accountant. Now, what does this report from an accountant says? It says that these are the taxpayer, they have maintained all the documentation which are prescribed under the regulation to justify their transaction is at ALP. And there's an annexure which gives the particulars of the transaction. So there are various clauses, right from clause 10 to clause 23. It contains details of clause 10 is details of associated enterprise, where we need to put in what the name of the associated enterprise, what is the relationship, what is the business they are carrying out. If you have a tangible transaction of any kind of a tangible property purchase and sale, then clause 11 is applicable. Intangible needs to be reported in clause 12. So it's a proper prescribed format in which the transaction needs to be disclosed upon. And this is a certificate which is obtained from a accountant, a chartered accountant. Now, how we as a professional go about with the Form 3CEB issuance. Now, I would say that issuance of form number 3CB is no different from any other kind of an audit. And therefore, before accepting any kind of an engagement for form number 3CB, there's a requirement that a no objection certificate, NOC, like in case of a audit, needs to be obtained from an erstwhile transfer pricing accountant of the taxpayer. So NOC needs to be obtained before we undertake any kind of a new engagement, any kind of an engagement for a new client. What are the process that this preparation of a form 3CB entails? One would be proper identification of an associated enterprise. We saw the definition of associated enterprise. It will be critical that all the parties with whom you have transacted needs to be tested if they satisfy an AE condition. If yes, those needs to be pulled out as a part of a reporting obligation. Identify what are the transactions which have been undertaken with those associated enterprise. How do you conclude that those are at arm's length? So there's a benchmarking. Benchmarking entails your going through those 6 methods. How do you apply those 6 method, and we test whether the transaction is at arm's length or not. We verify the basic documentation of a transaction, be it invoicing, the ledger, the reporting, what are the other details which have been maintained, the agreements, what are the other details which have been maintained by a taxpayer in terms of that transaction. Now, this is a typical process which is followed for a form number 3CEB issuance. Now, the things come that is a revision of form 3CB allowed? Now, unlike revision of a return of income, of course, which has now been, which is again now not permissible because you have a limited provisions to update your return of income. Similarly, there is no provision under the Act to revise a Form 3CB. And therefore, special care needs to be taken that all the transactions are properly and accurately disclosed. Again, second thing is that the form number 3CB speaks of true and correct. So unlike an audit assignment which says true and fair, whereas there's some kind of a materiality threshold, here the standards are true and correct. And therefore the standards are much higher than any an audit, normal audit procedure. So, special care needs to be taken that there's no mistake even of a 1 rupee, because you are certifying that everything is true and correct. Just going a step further, we discussed regarding the revision of Form 3CB. While there is no provision under the Act, the income tax utility allows you to revise a Form 3CB, and from a practical purposes, we have seen Form 3CB being revised, but it is not advisable because currently, technically, there's no provision under the Act to revise a Form number 3CEB. Moving on further to what kind of documentations do a taxpayer needs to maintain. Now, as we said that transfer pricing is a global subject, lot is being done and is in process of being done as a part of global studies, and OECD, G20, UN, they have issued various kind of guidelines, and one such important project which was undertaken by OECD along with G20 countries was base erosion and profit shifting, where they prescribe certain 15 BEPS action plan, which are, generally known as. And one of the BEPS action plan 13, it prescribed three-tier TP documentation. And we, India, as a participant to the overall BEPS project, we adopted the three-tier documentation as a part of our TP regulations in 2017. So from financial year 16-17, multinationals, apart from maintaining their typical transfer pricing documentation, which is supporting their international transactions or specified domestic transaction, which is more so known as a local file, we also need to prepare, the taxpayers also need to prepare and maintain the master file and country by country reporting. Now, just to ensure that, the small taxpayers are not burdened, there are high threshold which are prescribed for applicability of a master file and a country by country reporting. So let's just look at it in summary. What are these? Master file is like a blueprint of a group. It will give you what is a business of the group, what are the key stakeholders, key entities as a part of the group, what are the important intercompany service agreements as a part of the group. So it's like a blueprint of a group, more of a qualitative data, which is filed before the income tax authorities. There are threshold to this, and which we will see it in a later slide when we cover this in some more detail. We also have a local file. Local file is more country specific, more transaction specific, and here the details which are given are more to support why a particular transaction which have been entered into between two associated enterprise, how that is at arm's length. We have, as a part of the three-tier, there's country by country report. Now, country by country report is more to do with quantitative data of a group, while master file is more of a qualitative data. Country by country report is more of a quantitative data to show at one platform to the income tax authorities that these are the countries in which as a group we have a presence. This is a profit revenue that we are earning in each of the jurisdictions. So country by country report is a jurisdiction wise quantitative data which is given. So these are the numbers, or these are the revenue amounts which are earned in each of the jurisdiction. This is a profit that has been maintained in each of the jurisdiction, the employees. So there are various quantitative data which are given as a part of country by country reporting. Country by country reporting, the threshold is very high. It refers to a consolidated group revenue of INR 6,400 crore. So the threshold is very high from an applicability perspective, and also to ease the compliances. The government has said that you can file a country by country report in any one jurisdiction, and there'll be an exchange of this information through treaty partners. So there's no separate compliance that as an individual, as a taxpayer, we need to do, or we need to file this report if, let's say, the headquarter company has already filed a country by country report in its jurisdiction. So as a part of an intimation, we just need to intimate to the government. There's a specific form which has been prescribed to say that so-and-so entity in so-and-so jurisdiction is filing a country by country report on my behalf, and the government will automatically get the access to that CBCR through treaty exchange channels. Now, referring to a local file, which is a critical documentation which needs to be maintained by every person. Again, to reduce the compliance burden, there's a threshold of INR 1 crore for international transactions, and SDT, again, 20 crore, which has been prescribed. So if you have undertaken an international transaction of, let's say, 50 lakh, then you need not maintain each of these information, onerous information, because you will be exempt from maintaining the documentation under section 92D. Now, what do the TP documentation entail? Now, maybe you would have heard about transfer pricing study report, which is a term loosely used to a report which basically compile all this data in one form and is prepared as a compiled report kind of. format. What does this require? So simple, if one were to look at it logically, the requirements from a TP documentation are you give what is your business, what is your group business, what is your associated enterprise doing, what are you doing. So it requires you to document the business profile of the group, of the multinational group, of the taxpayers, of the associated enterprise, give an ownership structure, your shareholding structure of your group, which we call it as a corporate background of a taxpayer. It requires you to also disclose a overview of the industry in which you operate, because in a commercial sense, your transaction do get influenced by the industry in which you are operating. If let's say the industry is into a reclining stage, or it is into some kind of recession or depression kind of a thing, then probably your pricing would be influenced by the factors which are external factors. So in order to capture the external factor impact of the external factors on your pricing, industry overview needs to be documented. You give an overview of what your transaction are, what are your international transaction, what is the pricing pricing of those transaction, how are you undertaking. So your overview of the transaction is something which again is part of the TP documentation requirement. And the second the next, which is like a heart of the entire TP provision, it is your functional analysis. So you document what is the activity that you are doing. If you are rendering a services, what kind of services you are rendering, what is the role played by you and the other entity, which is the associated enterprise, in carrying out those activities. So that is part of the functional analysis which gets documented in a TP study. And then comes the mind, which is the economic analysis, which is the benchmarking. How do you say, why do you say your transaction is at arm's length? So we document which is a method that we have used. It is not only to document the method that we have used, but we also need to document why we are rejecting the other methods. So there are 6 methods. So if we are selecting transactional net margin method, we also need to document as a part of a TP requirement, TP documentation requirement, that why are you rejecting the other 5 methods. So that's an important aspect when we are preparing any kind of an economic analysis. So this basically your record of uncontrolled transactions, and why do you select a particular method, or how have you concluded that your transaction is at arm's length, that comes as a part of your TP documentation. And all these requirements are prescribed under Rule 10D, wherein these rules have been prescribed. This typically is what we just saw is typically the local file which gets maintained. As we saw, we have other 2-tier documentations also, which is master file and country by country reporting. Master file, again, we have certain high threshold. It refers to if you have a consolidated group revenue of 500 crore and your value of international transaction is 50 crore, or if you have entered into any intangible transaction of 10 crore. So it's a dual condition which have been prescribed, your link to your consolidated group revenue and your value of international transaction. And if you are satisfying these conditions, you need to maintain a master file and file it in India in form number 3CE AA. There are 2 parts to it, part A and part B. Entire form will become applicable if you satisfy this threshold. If you are not satisfying this threshold and you are part of an international group, still you need to file part A of form number 3CE AA. Now that's how the law is. There's no reason why I need to file part A, but still you will have to file part A as a part of master file provisions. Country by country report, again a very high threshold of 6,400 crore for a consolidated group revenue. Now it refers to it is applicable to an international group. Now, what do you mean by international group? Let's say if you are an Indian headquartered company with only a branch in Dubai. There's only one branch in Dubai. Now, that branch for all practical purposes is considered as a permanent establishment. For purposes of application of a country by country reporting rules, it will be considered as a permanent establishment outside India. And therefore, you will be considered as an international group. And if your threshold is more, if your consolidated revenue is crossing 6,400 crore, you will be required to file a country by country reporting in India, even if there are no international transactions. So your CBCR is not linked to the value of international transaction or occurrence of an international transaction. It's linked to your consolidated revenue. And if you are an international group even refers to a branch which is outside. So so maybe, you know, even if you even as an Indian company, if you only have a one branch, then probably CBCR provisions may get triggered or may get applicable if you cross the revenue threshold of 6,400 crore. There are very stringent penalties in terms of non-compliances of TP provisions. Form number 3CEB, if it is not filed within the due date, there's a penalty of 1 lakh. Okay. But if you have failed to report any international transaction, or if you have not maintained your TP documentation, the local file that we just saw off, or if you have not furnished any documentation during an assessment proceeding, then the penal provisions are very stringent because they are linked to the value of transaction, international transaction. So it says 2% of the value of international transaction. If in case the taxpayer is faced with any kind of an adjustment, then the penalty provision under 270A are applicable. And if it is an underreporting, if it is underreporting, then 50%. If it is misreporting, then 200% of the tax payable is considered as a penalty. There are also stringent penalty for country by country report and master file. If you fail to furnish a master file, then there's a penalty of 5 lakh. And if you fail to furnish a country by country report, then the penalty is per day. So if your delay is less than 30 days, then you will be penalized 5,000 rupees per day. And if your delay exceeds 30 days, then there's a penalty of 15,000 rupees per day. So the more you delay, the more the penalty is. There is also a penalty of incorrect information, or if there's any kind of an information which is asked by the tax authorities and you don't produce as a part of country by country report provision, then the penalty increases from 5,000 rupees per day to 50,000 rupees per day. So there are, in short, the penalties are stringent than any other provision as far as the TP regulations are concerned. How does a TP audit process works? So once you have filed your form number 3CB, you have filed your, the taxpayer has filed his return of income, the case gets selected for a scrutiny. As a part of the scrutiny, if the transfer pricing risk parameter, so earlier there was a threshold of international transaction which said that if you have undertaken an international transaction of more than 5 crore or more than 15 crore, then your case will mandatorily be referred to a transfer pricing officer, which is a special wing to carry out a transfer pricing audit. As opposed to that, we have moved from a value-based assessment to a risk-based assessment. And as we know today, a lot of cases are being selected for scrutiny under the CAS parameter, which is computed aided scrutiny system generated reasons. And if any one of the reason for the selection of a scrutiny is a transfer pricing risk parameter, then the case has to be mandatorily referred to the transfer pricing officer for an assessment. There are other risk-based assessment also. If your case is not selected under CAS, then there are particular provisions. Instruction 3 of 2016 is a particular relevant instruction which deals with when a case can be referred to a TPO. If your case gets referred to a transfer pricing officer, as of today, the transfer pricing is not faceless. So while your normal resident taxpayers have moved to NFAC regime, TP wing is still face-to-face, where while the proceedings are conducted under e-proceedings, it's still the hearings are called for, the noting sheets are taken, and the process is undertaken. So it's still, the TP has still not moved to a faceless regime. How does a typical TP assessment or TP audit works for? The TPO will issue you a notice. The TPO issues a taxpayer a notice to say that, yes, your case has been referred to me. You give me the basic requirements. So he will ask for the basic details like the TP study, the agreements, what are the comparables, the annual reports of the comparable companies, and those all details get asked. Then he will analyze those details in case there are any additional factual information that TPO asks. And if he is not satisfied with the pricing that you have entered into, there is a show cause notice which gets issued by the TPO. And once you reply to that show cause, probably he will close your assessment either in your favor or against. Now, let's say that the TP assessment gets closed against you. There's a TP adjustments which happened. The TPO will issue a TPO order, which will be sent to the assessing officer, as well as a copy being served on the assessee, which will give the TP adjustment. Now, AO, he has to incorporate the TP adjustment as a part of the assessment order. He cannot deviate. The law clearly says that he has to incorporate. So he has no way to deviate from the adjustment which is made by the TPO, and he will incorporate it as a part of the assessment. Now, because there's a TP adjustment, you will be considered as an eligible assessee under section 144C, and you will be given an alternative route to approach a dispute resolution panel, which is more of a faster route to reach the tribunal. And as per the provision of section 144C, the assessing officer will issue a draft assessment order at the first instance. So there'll be a draft assessment order which will be passed. Once we receive a draft assessment order, it's the option of the taxpayer either to approach a dispute resolution panel, which is an alternative mechanism to CIT appeal, or to go via a normal CIT appeal route. If the taxpayer opts for a DRP, we need to file a DRP objections within 30 days from the receipt of the draft assessment order, and DRP needs to give its direction or needs to dispose of those objections within 9 months from the date of the draft assessment order. So there's a strict timeline which has been prescribed for disposal of objections before the DRP. If the taxpayer does not want to approach a DRP, then the taxpayer will write to the assessing officer to say that I don't intend to go by the DRP route. Please issue me a final assessment order, and the AO has to issue the final assessment order within 30 days from the receipt of the intimation, or within 30 days from passing of the time limit for filing the DRP objection. So assessing officer will pass the final assessment order. With that final assessment order, I will now approach, the taxpayer has the option to now approach the CIT appeal route. Now, what if CIT or a DRP, they also pass a negative order or an order which is not in favor of the assessee? Then we have an option of going before the income tax tribunal or to the High Court on a question of law. Today, the question of law before the High Court could also be a question of fact if it is perverse. Especially in case of a transfer pricing, if you believe that no, it's a perverse to include Infosys as a comparable to something which is a taxpayer who is only a call center, then yes, it could be considered as a question of law. So you can also go to High Court, and from that to the Supreme Court. Now, this is basically an audit, typical how an assessment or an appellate cycle works in India. Now, as we saw, India is in fact the highest litigator as far as the transfer pricing cases are concerned, and therefore there was a need to come out with alternate dispute resolution mechanism, because this somewhere is linked to transfer pricing. It's related to the transaction with the other counterpart which is in other countries. So there's a need to show that yes, we are not unnecessarily burdening the multinational companies or going after them without any reason, and therefore alternate dispute resolution mechanism in form of advance pricing agreement, mutual agreement procedure, and safe harbor are a part of the Income Tax Act. What is APA? APA is basically a mechanism by which the taxpayer can approach the CBDT and agree with them the pricing for their international transaction, or how they would be benchmarking a particular, how they would be determining an ALP of a particular transaction. So it's basically an agreement, an advance, in advance to a transaction. I'm entering into an agreement with the CBDT to say that this is what is a pricing which is agreed between you and me for my transaction, and therefore I'll be saved from maintaining any kind of a TP documentation or going through the normal assessment audit cycle. There's still a requirement to file a Form 3CB because you have to disclose to the tax office the transaction that you have undertaken. Now, for what period is APA available? APA is available for a period of 5 years and a rollback of 4 years. So total a period of 9 years get covered as a part of the APA. There are set rules on how the APA programs will work. When could a agreement be considered as null and void? The procedure to revise an APA agreement in case there are any changes in fact. So those specific rules are part of the Income Tax Act. We also have the MEP route, which is available. This is basically where two competent authorities of the country will come and agree that this is what the taxation would be. This is what the pricing would be for a particular transaction, and you get a corresponding relief in the other country. So let's say as a taxpayer, I have priced my transaction of sale of services at cost plus 10%. The tax department in India views that no, it should be cost plus 20%. There's an adjustment which has happened. So MAP, I can approach the MAP route as an alternate dispute resolution while I pursue my normal litigation route before the tribunal, before the CIT appeal and the tribunal. I can also approach through the MAP route where I request the two competent authorities to meet and discuss on the appropriate pricing and the tax that needs to be paid in each of the country. So let's say the two competent authorities, they come together and say that no, cost plus 15% is an appropriate. So I will in India 5% additional will get taxed, and corresponding relief will be provided by the other counterpart, wherein they will let go of they will provide the tax credit for the payment which have been done in India. So mutual agreement procedure is basically a route where the past assessment cases could be discussed and agreed on, negotiated between two countries. We also have something which is known as a safe harbor rules. Safe harbor rules were prescribed and they are applicable to certain set of taxpayers and a transaction. Basically, the entire ITES industry was facing a huge TP litigation, and therefore there was a dire need to come out with some kind of a safe harbor for them to say that, okay, if you are pricing your transaction between so and so. So right now we have a safe harbor of 17 and 18% for ITES and software development kind of a companies. So if you're pricing your transaction, then those will be accepted without further scrutiny. But again, the safe harbor, if you are applying, if you want to opt for a safe harbor, there are specific provisions where you need to apply, make an application. Unless you make an application, the safe harbor provisions are not will not be applicable per se. While they will have a guidance value, they will not be applicable. If you want to opt for, there's a proper form and other means that needs to be opted for. Now, we have also adopted an international concept of secondary adjustment as a part of TP regulation. What does secondary adjustment mean? Let's say if there is any kind of a TP transfer pricing adjustment which has happened. Now, while the taxpayer was paying the tax in India, India was not getting the appropriate foreign exchange or the cash for the appropriate pricing. Let's say I have priced my transaction at 100. I'm receiving 100 from my associated enterprises for my particular transaction. The actual arm's length value of this transaction is 500. I will offer 500, 400 as a TP adjustment and pay the tax on that differential of 400. But India was losing the foreign exchange because if had this transaction been undertaken between two independent party, India would have got 500 in terms of the cash, actual cash. Now, in order to remove this kind of an imbalance between the cash which is being received and the actual profit which is being offered, the provisions of secondary adjustments were introduced in the Act. What does the provision of secondary adjustment says? It says that if you have any TP adjustment, which is known as a primary adjustment in technical term, of more than 1 crore, then you have to bring in the amount into India. If you don't bring in the amount into India, then it will be considered as if you have given an advance to your associated enterprise, and the interest on that advance will be an additional income in your hand, which will be tax on which will be payable every year. So it will be considered as an interest-free advance, and there will be an interest imputation, which will again be which that interest imputation is nothing but a secondary adjustment. So there is an adjustment, TP adjustment, which has happened, which is a primary adjustment. I'm not bringing in the amount for that primary adjustment, and therefore there's an interest which gets imputed on that adjustment to make another line of adjustment, which is termed as a secondary adjustment. So right now, a time limit of 90 days is given under the act to repatriate that amount into India. If you don't repatriate within 90 days, then the interest will become applicable. Now, whether this interest adjustment needs to continue till perpetuity, yes, unless the taxpayer opts for a one-time settlement. This one-time settlement is a one-time tax payment of 18% on the excess money. So whatever excess money is lying with the overseas, if I agree to pay 18, if as a taxpayer I agree to pay 18% on that as a one-time settlement, then we don't need to offer year-on-year interest as an interest adjustment every year on the primary adjustment which has happened. Now, having understood the transfer pricing provisions, of course, it is very important as a corporate professional, as a corporate, to have your transactions, priced from an arm's length perspective, because today there's increased transparency, there's increased focus on the corporate governance and other aspect. But as a professional, what are the areas that we can assist? Our opportunities lie right from the pricing of a transaction. So we can advise the client, we can work with the client to price their transaction, so that the pricing is not deviant from the arm's length principle. So we can assist them in transfer pricing setting, price setting, which is transfer pricing planning, transfer pricing compliances, which is like a bread and butter for the professional, helping them or issuing a form number 3C EB to them, helping them maintain their TP documentation, helping them do their master file and country by country reporting obligation. In case there is any kind of a TP assessment or TP scrutiny that is being undertaken, then we can assist them in that litigation cycle in terms of their TP assessment, their DRP proceeding, representing them before the ITAD, and also assisting them in briefing the council to the high courts and the Supreme Court. As a professional, we also have an opportunity to work with the taxpayers in case they would wish to opt for the dispute resolution mechanism, to say either be it an APA or an MAP or a safe harbor. So these are the overall opportunities and offering as a professional we can serve in this domain area. I think that was it from my side. We'll be happy to take any question. And let me tell you, friends, this topic is such that a lot of work has been done globally. There's a lot of material on it for reading, and it's an ocean of information on this, and it's an area which is interesting, because no two taxpayers are the same. Even if you would have worked on one client, the other client will have its own nuances, its own way of looking at the industry, its own way of conducting a business, and all those aspects needs to be taken care of when we are dealing with this kind of a subject. And this is a subject which is not only restricted to India boundaries, it's a global subject. Anywhere in a country we go, the basic principle of transfer pricing remains the same. You have the same 5 methods of arm's length determination. The definitions of associated enterprises are more or less similar. You have the same provisions of secondary adjustment. Sorry. Yeah. So let me tell you, this is a subject, it's an interesting subject, not at all a boring. And when I joined this field of transfer pricing, I was told that TP is neither an art nor a science. So what is it? It's magic. And so hope you will enjoy, and I'll be happy to take any question and answer we have.
I only have one question. Could you please, I have actually one confusion. There is a company, I've also messaged in a chat box, but I'll explain in the short. There's an US company who is giving some sort of services to an Indian private limited company. Okay, they are not selling anything. They have only signed an agreement that you do some sort of marketing and we will pay you. So they have set up that expense and they are getting reimbursed for those expenses and few marketing charges the Indian company is charging. So as there is no such association as per definition, thus it comes under the purview of transfer pricing.
See, for transfer pricing to get applicable, they have to first be an associated enterprise. If they don't have any kind of an association or they don't fall within the 13 clauses, then they will not be termed as an associated enterprise as such. But as you said, we have this one particular clause where we don't have a threshold. And there we have to, apply some kind of a professional judgment whether this particular relationship, whether it has a trig or it could be considered to have exercised any kind of a control on the Indian enterprise. If the answer is no, the TP provisions will not be applicable.
It can be assessed as an export of service, right?
It can be exported as a normal export of services, yes.
Anybody who want to ask
Any other questions we have?
I think we have few questions in question
Yes.
answer box and
Okay.
even in the chat room also. So
My-
can you go through or should we read out?
Maybe I will just go through it. My parent company based out of Switzerland enters into an agreement with a party in India to pay commission based on business brought in by them. However, the commission is paid by Indian company for ease of operation. Is this deemed international transaction? So for a deemed international transaction to get triggered, there has to be an agreement with unrelated party, and the terms of those arrangements should be in substance determined by a related party. So if those fact patterns are not satisfied in this case, probably it is not a deemed international transaction. Again, it's a factual exercise. We will have to really look at the arrangement agreements and terms. Can a comparison be done by comparing prices charged by the tax-paying entity to associated enterprise and price charged to non-associated enterprise? Yes, it is a way. It is called as an internal cup in a technical sense, where if you are dealing with both associated enterprise and a non-associated enterprise for the same product, then you can do an internal price comparison. Any other question? I think branch and associated enterprise, we answered it in the session earlier. In the chat box, do we have any question? I think Vartika we discussed, Garima we
you
discussed.
answered,
Yeah.
my question. Thank you.
I think I don't see.
Whether, yeah, I think
Karthik has a question. When TP adjustment required for standby letter of credit or a bank guarantee provided by holding company to its wholly owned foreign subsidiary, which method to be used for arm's length calculation? Now, Karthik, guarantee is considered as an international transaction. We don't have any prescribed guidelines on how to benchmark, but generally considering the global practice, interest saving approach is generally adopted to benchmark a guarantee rate, where we see that what is the saving which has happened because of the guarantee which has been provided by the holding company to the bank for that loan transaction, and then we do some kind of a split on those saving rate. So that's an interest saving approach which gets generally adopted. Standby letter of credit, again, there are divergent ruling on this. The content of the letter of credit needs to be seen, whether that standby letter of credit is moving, or the wordings of the standby letter of credit are moving towards an indication that it's a form of a guarantee, then the it will be considered as an international transaction and a benchmarking needs to be done. If it is more of some sort of, just to give or just to state that I will not be liquidating my position or this entity is part of my group, just giving an information kind of, then probably one can argue that it is not akin to a guarantee and there's no service element in this standby letter of credit, which is given by holding company to the wholly owned subsidiary. Will the reading of DTAA help? Yes, because we do have associated enterprise definitions and, those arm's length principle enshrined in the DTAAs. However, specific provisions and the compliance, we need to look at the Indian regulations. I think that's it. I don't see any more questions. Anything I'm missing?
I think it's major covered.
Great. Hope it was useful and maybe, the basic concept, they were clear to that extent, and it's a good subject for a detailed study.
Of course, you
Practice.
explained, of course, in depth, and I'm sure everybody will be benefited from this sessions. So really, thank you so much, Shazia, for sharing your knowledge with all of us.
My
So
pleasure.
I think we should move forward for we have reached to the end to the session. So we'll request to Vartika for official vote of thanks, and then we can close the session.
Thank you, ma'am. I would like to extend a warm vote of thanks to our esteemed speaker, CA Shazia Khatri, for sharing her expertise on the transfer pricing with us today. Ma'am, your insightful presentation and the real-world examples which you gave greatly enhanced our understanding of this complex topic. We actually appreciate the time and effort you took to deliver this informative session to us today. On behalf of my team and all the participants, I really express our gratitude to you. Thank you.
Thank you. Thank you
Thank
so
you
much.
so much. It was my pleasure. Thank you.
Yeah, look forward for such more sessions.
Thank you, Shazia.
Thank you.